I modeled what Tesla's TSLA income statement might look like in Q1 2020 with sales of 10,000 Model 3s per week and big growth in the energy business. Here my model. Source, author image. You can click on the image to enlarge it. You can also click here to get a copy of the spreadsheet. The headline figure is $645 million in net profit for the quarter. Annualized, that's $2.58 billion. See below for my discussion of how Tesla should be valued based on this profit. Here are my notes on the various line items in my model. Model S and X revenue, I'm assuming a $100,000 average selling price, ASP, and sales of $25,000 per quarter. Model 3 revenue, I'm assuming a $42,000 ASP, management estimate, and sales of 10,000 units per week or $130,000 per quarter. Energy generation and storage revenue, I'm assuming 91.6% annual growth in energy generation and storage revenue between Q1 2018 and Q1 2020, extrapolating from growth between Q1 2017 and Q1 2018. This projection might turn out to be too high, but I'm optimistic about large-scale utility battery projects and solar roof. At the recent Tesla shareholder meeting, management guided that it planned to install 1 gigawatt-hour of battery capacity over the next year. By comparison, so far Tesla has installed 1 gigawatt-hour of battery capacity in its entire history as a company. Management also guided that, in the following year Tesla would install 2 gigawatt-hours of battery capacity, and 4 gigawatt-hours in the year after that. This would represent more than annual doubling in Tesla's battery deployments. If revenue can be expected to grow commensurately, this guidance supports my projection of a 91.6% growth rate over the next 2 years. Starting in 2020, California will mandate that all new homes be built with rooftop solar. California builds 80,000 new homes per year. This will be good for sales of Solar Roof, Tesla's conventional solar panels, and its residential Powerwall battery packs. If Tesla can sell 5,000 solar roofs globally in Q1 2020 at an ASP of $50,000, including the Powerwall battery, that's $250 million in revenue, or 21% of the growth I'm projecting between Q1 2018 and Q1 2020. If it can sell 10,000 solar roofs, that's $500 million in revenue or 43% of my projected growth. Services and other revenue, I'm assuming 78% annual growth in services and other revenue between Q1 2018 and Q1 2020, extrapolating from growth between Q1 2017 and Q1 2018. Since this category includes vehicle maintenance, it should increase significantly over the same period that I'm projecting production volume will more than triple. Since I'm also assuming a 0% gross margin, this growth rate projection has no impact on the bottom line. Model S and X gross margin, I'm projecting a gross margin of 30%. This is based on management commentary, historically high gross margins, and expected higher ASPs based on increased demand with supply capped at around 100,000 units per year. Note, cost of automotive revenue includes depreciation of factory equipment. Model 3 gross margin, I'm projecting a gross margin of 27.5%. This is based on management commentary and a tear-down firm's analysis that estimated parts and labor costs at $28,000 per car at a production rate of 10,000 units per week. That would put gross margin at 33% at an ASP of $42,000 before accounting for other costs of revenue. Energy gross margin, I'm assuming a gross margin 8.4%, as in Q1 2018. Gross margin will probably improve. At the recent shareholder meeting, CFO Deepak Ahuja said Tesla's long-term target is a 20 to 30% gross margin for the energy business. To keep this model conservative, I'm still going to assume an 8.4% gross margin. I will be watching to see how, if at all, energy gross margin changes from quarter to quarter. Services and other gross margin, I'm assuming a gross margin of 0%. from Tesla's 10K. Services and other revenue consists of maintenance services, sales of used vehicles and sales of electric vehicle powertrain components and systems to other manufacturers. Management has said it intends to run maintenance services at a break-even in the future. Those other revenue categories will probably have positive gross margin, but I don't know how to estimate it and I don't want an inaccurate guess to distort my model. Research and development, I'm assuming 14% annual growth in R. A significant portion of R. Sales, general, and administrative, I'm assuming 13.7% annual growth in SG. According to Tesla's most recent 10K, supercharger costs are counted under cost of revenue. Moreover, management has said it intends to eventually run superchargers at a break-even. Warranty reserves and maintenance are also counted under cost of revenue. SG. In 2010, it hired George Blankenship as its VP store design. Blankenship previously helped Apple launch its first stores. As of Q2 2017, Tesla had 300 stores worldwide. By comparison, Apple currently has around 500 stores worldwide. As sales volume soars, I think there is room for Tesla to make much more use of its existing stores. Interest expense, net, I'm assuming this will be the same as in Q1 2018, on the, possibly wrong, assumption that Tesla will not increase its total debt. Other expenses, I'm assuming this would be the same as in Q1 2018. It's such a small amount that even an error of 100% would have a small impact on the bottom line. Income tax, I'm assuming an effective tax rate of 23%, the same as PS. Tesla headquarters in Palo Alto, California. Photo by Tumbenhauer. How much is Tesla worth based on $645 million in quarterly profit? It is difficult to know what the appropriate P/E ratio for Tesla is in Q1 2020. There are a few possibilities. Click on the image to enlarge it, or click here to get a copy of the spreadsheet. My personal favorite is the S. That's because it abstracts away the problem of categorizing Tesla with other companies. Tesla isn't Toyota, TM, and it also isn't Apple. It's a unique company with idiosyncratic growth prospects, risks, and financials. Taking the long-term historical average also abstracts away current market conditions. On this P/E ratio, Tesla would be worth $41 billion, about $9 billion less than today. However, that's before pricing in the difference between Tesla's growth rate and that of the S. What will probably matter more in Q1 2020 than any of these ratios is our projections for Q1 2021 earnings. The operative multiple will be the forward P/E ratio, or the forward PEG ratio. The Model Y and a higher Model 3 volume. The Model Y is scheduled to begin production in 2020. With the Model Y, I think Tesla will be able to generate more net profit than from the Model 3. Demand will probably be higher because overall demand for crossovers is higher than sedans. Gross margin will probably be higher due to lessons learned from Model 3 production. The Model Y will rely on a lot of the same sales infrastructure and software are. So I think both revenue and net margin will be higher. Similarly, I think Tesla may be able to double Model 3 sales from 520,000 per year to over 1 million per year. I think this is because the Model 3 will offer value for money that's unseen elsewhere in the car industry. Based on analyst Gene Munster's estimates, over 5 years the cost of owning a base Model 3 will be only $4,200 more than owning a base Toyota Camry. Over 10 years, if we extrapolate just the energy savings, it's only $1,100 more. If we extrapolate both the energy and maintenance savings over 10 years, a Model 3 will actually cost $1,400 less to own than a Camry. Then there's vehicle lifespan. A gasoline car is typically done after 200,000 miles. The expected useful life of a Tesla is much longer, maybe as long as 500,000 miles. One Model X has traveled over 300,000 miles and is still in good condition. So after 200,000 miles in a Camry, you'll probably have to buy a new car, whereas a Model 3 could last much longer. On a cost-per-mile basis, then, the Model 3 is likely to be much cheaper. Given that the Model 3 is a more luxurious car than the Camry, with more advanced technology and better driving performance, why would anyone pay more for a Camry? YouTube channel 2Bit Da Vinci has a different cost of ownership estimate, with much higher projected maintenance cost. Still, extrapolating the average savings of $580 per year that it estimates for the first 5 years, over 13 years and 200,000 miles, the Model 3 would cost only $760 more to own than a Honda HMC Civic. This is before accounting for the increase in maintenance costs that occurs for gasoline cars after their first 5 years on the road. A 20% increase in maintenance costs for the Civic after 5 years, with no increase for the Model 3, would make the Civic cost about $400 more to own over 13 years than the Model 3. Moreover, after 200,000 miles, the Civic will probably be ready to be decommissioned. The Model 3 could have another 100,000 miles or more of useful life left in it. Again, why buy a Civic if the cost to own a Model 3 is around the same or even less? Let alone a BMW OTCPK, BMW YY3 Series for significantly more. The Tesla Semi and the Tesla Network. My model doesn't include any revenue from the Tesla Semi, which was originally supposed to begin production in 2019. It would be difficult to estimate production, sales, and gross margin, plus I wanted to be conservative and assume that the semi-production will begin later. A pre-production Tesla Semi hauling a trailer. Photo by Corbiter. Also not included in the model is any revenue from the Tesla Network, a planned autonomous ride-hailing service. It is difficult to predict when fully self-driving cars will be commercialized. Google co-founder Sergey Brin predicted in 2012 that it would happen within 5 years. In January 2016, Tesla CEO Elon Musk predicted that Tesla would do it in about 2 years. Even for the people close to the technology, it's easy to get it wrong. I feel increasingly agnostic about the rate of development for self-driving technology. I feel that it could take 10 months or 10 years, and it's hard to know which is more likely. Deep neural networks are mysterious even to the people who develop them. They are less like traditional software than they are like biology. Developers are like genetic engineers creating a new organism and watching how it behaves. Deep neural networks can be breathtakingly smart and goofily inept, and how they even work is an ongoing topic of debate. So, it seems possible to me that the performance of deep neural networks for driving-related perception tasks could improve from significantly subhuman to significantly superhuman by Q1 2020. It also seems possible that deep neural networks could hit a wall and self-driving development could stall. With that caveat in mind, let's imagine that Waymo, Cruise, GM, and Tesla are correct in predicting the commercial launch of self-driving cars within the next 2 years. Based on this timeline, investment research firm ARK Invest forecasts that the global autonomous ride-hailing industry will have a combined market cap of $5.5 trillion in 2021. If Tesla could capture even 1% of that, its share would be about $5 billion higher than its current market cap. A 20% share would propel Tesla to $1.1 trillion in market cap, a 22x increase from today. There is fundamental uncertainty here. Currently, the stock market seems to be pricing the net present value of autonomous ride-hailing at approximately $0. ARK Invest, by contrast, estimates it to be $2 trillion. Over the next 2 years, we will get more information about which figure is more accurate. Erring on the side of conservatism, I assumed $0 in revenue from autonomous ride-hailing in my Q1 2020 model. Risk factors. Growth is a double-edged sword, particularly with manufacturing. With the Model 3, Tesla has built a manufacturing system bigger than the manufacturing system for the Model S and X. This means that the Model S and X business can't possibly cover the costs of operating the Model 3 manufacturing system. The Model 3 needs to start generating net profit and free cash flow in the next few quarters, or Tesla will need to raise capital to avoid collapsing under the weight of its own ambitions. A growth company in manufacturing should be thought of like a rocket. Fast, but dangerous. Even if net profit and free cash flow are achieved as a result of the Model 3 program, it is entirely possible that gross margin will be lower than what I'm projecting. It's also entirely possible that SG. How these line items turn out depends on Tesla's new manufacturing system and its unique retail strategy, neither of which have yet operated at the scale I'm projecting for Q1 2020. Conclusion: based purely on $645 million in quarterly earnings, Tesla would be worth somewhere in the ballpark of $41 billion to $62 billion in Q1 2020, depending on market conditions. However, considering its growth prospects in subsequent years, it ought to be priced higher. There is the potential for earnings to increase several times over in 2021, 2022, and beyond. I look forward to critical, yet respectful, feedback from readers. Thanks for taking the time to read and share your thoughts. Disclosure: we are long TSLA. I wrote this article myself, and it expresses my own opinions. I am not receiving compensation for it, other than from Seeking Alpha. I have no business relationship with any company whose stock is mentioned in this article.